Mr. Broadhurst, Mr. Owen, Mr. Reeford, Councillor Will, Mr. Davey and Councillor Lowry. I don't believe there are any others, Mr. Trahan. No? May I ask, do you have any declarations of interest? Councillor Wason?
As chairman of the Audit and Transparency Committee, we're looking at the pension fund accounts, which I've signed.
Thank you. No other conflicts of interest or declarations of interest? The minutes of the meeting held on the 30th of September 2021, in terms of accuracy, we'll come to matters arising in a second, but in terms of accuracy, are you happy for me to sign them as an accurate record of the meeting? Some nodding heads would be useful at this stage. Thank you. Nodding heads received. Thank you. So I've signed those. Then looking at the action tracker, which we've just had circulated, let's go down the list, if we may, from top to bottom on the white ones. Mr. Triggs, yours is the, in fact, most of them are you, but do you want to start from the top and keep going?
Yes, so thank you, Chair. So starting with the first one, the ESG strategy for the direct property. The document was circulated and we await comments from committee members.
Just on that one, I might have missed it, which is very, very possible, but I can't remember seeing the Word version of that. Did you send it round? Did others get it?
Yeah, that was circulated.
Sort of shaking heads on our side. I mean, would you mind just recirculating it, in which case I don't know quite where it got to. I think the idea was that it would be in Word version and then we would type comments straight into the document rather than send a whole load of emails around.
Certainly, Chairman.
If you wouldn't mind. Thank you. Sorry if you'd already done it, but maybe it just didn't land with any of us. Mr. Hubbard has it, he says.
So with the rebalancing policy, that's within the agenda tonight. Quarterly performance review, and this was the look at the private equity strategy. So again, that's an agenda item on tonight's agenda. Cash flow forecast, copy to be circulated to the Pensions Board. So the Pensions Board met yesterday, and that was one of the items under discussion. Nothing negative brought to that. The responsible investment statement, so that's for the fund as a whole. Again, members invited to send in their comments, and we have had one set of comments from Mr. Hubbard, for which we thank him. But very happy to take any further.
I suspect that was a bit like the other one, that probably it hasn't landed, so if you wouldn't mind recirculating the Word document.
I will recirculate that as well.
Thank you.
And then with the passive equity mandate, the process of transfer from Algym to BlackRock, almost complete. So the papers on tonight's agenda show a particular completion point, which has been updated by another paper which I've circulated to the members in hard copy just now. So that, again, that's an agenda item for tonight's agenda. And then with the CIV's capital change, the regulatory requirement by the FCA, again, that's on tonight's agenda, but part of the exempt items.
Thank you. And then the last one from November last year was CBRE to provide an update on the returns on the portfolio in its annual report to the committee. There is some returns data, but I think there's also a bit of a gap around Northern Trust, so we'll probably cover that off when we get to there in terms of benchmarking and returns and IRRs and total return aspect. So maybe we'll cover that when we get to that agenda item. Good, thank you. Those are, I think, all of the actions. Councillor Bennett.
Just on A7, so the policy document is here tonight. I've seen that. There's further information. Was that, I may have missed it, was that circulated by Mercer on, it was, what I understood when we added it to the action tracker is that it would be a sort of longer document discussing the sort of almost philosophy behind rebalancing and why it's a good idea, and maybe some statistics and that sort of thing. So I don't know if we...
I think, could you hold that point, because it's a point I also very much agree with. So when we get there, I think that's, maybe we can look to Mercer to address that.
Yeah.
That's a very good point. Colleagues, anything else? No? Okay, thank you for that. On the agenda, it says current outlook for global markets. I presume this was the Bailey Gifford presentation, looking at officers. Was that what that is? My proposal, assuming our guests don't mind, is that we actually take that towards the end of our meeting, because our friends from Bailey Gifford are going to stay with us afterwards. And so it perhaps makes sense to allow people who aren't staying to present first. So we'll move on then to the direct property update. I think probably this will require us to go into Part B session. So, Mr. Traherne, I'm going to propose that we move into Part B session. I'd need someone to second that proposal. Councillor Wason has seconded that. So, colleagues are all happy with that? Thank you. So we'll just pause for a moment as we go into Part B. It will mean, I'm afraid, to guests that we'll have to ask you to leave, sorry. We could do, yeah. thank you very much to our audience of millions. We're back. So paper A7 is on a review of the RAFI strategy. Is this Mr. Bradley?
Yes, and really it's worth beginning by reflecting on the purpose of this strategy, that the RAFI strategy is different from anything else that that RBKC has, in that it's a passive strategy that is weighted around some particular factors on a very strict equal basis. So there are 5 factors which apply: value, volatility, momentum, quality, and size. And these are factors which over time have proven themselves. And these weightings are just going to be very different from a standard market capitalization type portfolio, which is what we have for the other equities owned by the fund. And we've been invested with RAFI for almost 3 years now, and performance has been disappointing during that time. So the question is, does it remain fit for purpose? What is its role? Should one persist with it? And I think the main point that I would bring out is that it does perform a useful role in terms of being complementary, different from the other investments used by the fund. In particular, it's going to be very different from Baillie Gifford, and it's also going to be very different from the Legal and General, or BlackRock now, global equity exposure that the fund has. And it's also actually going to be different from the private equity mandate with Adam Street, to the extent that it's going to be invested in different kinds of companies. It's not going to be technology oriented. It's not going to be invested in the largest companies that are available in the market. It's going to be focused elsewhere. Net result of that is it's going to have a very different performance trajectory, and certainly in 2019, 2020, it performed very poorly, and there's in the paper there's illustration of that, particularly poorly relative to the Baillie Gifford fund, whereas this year, where we've had a different type of market, perhaps it's started to perform a bit differently, and I think that's what one would expect. And there are reasons to think that purely for a diversification type of reason, I think that there is a position for the RAFI strategy within the overall fund.
Thank you. I mean, I think it's always worth reminding ourselves that backward-looking performance is a really bad way of assessing how things have done. Providing we still think the premises on which we made the investment are sound, then we should look through periods of underperformance just as we should look through periods of outperformance. So I suppose the question to you is, as we look at the asset allocation that we have, as we look at the approximate optimization of our portfolio, does this take us, by including it, does it take us to a better risk-return space than would otherwise be the case?
And that's precisely the issue. I mean, I think my biggest concern, just looking at the fund as a whole, is the degree of concentration within the portfolio. It's a portfolio that has done fantastically well because of that concentration. There's no doubt about that. But on the other hand, one should remember that it is very focused on large cap technology will dominate, and US large cap technology in particular, and that's true right the way across the portfolio. That obviously has been the place to be in the past, but is that sustainable? At some stage that will change, and I wouldn't want all of the portfolio just to be focused on one area. You need to be looking at other opportunities, other areas of the market, and that's what this portfolio achieves.
I think it would be useful maybe as a follow-up if you could do some analytics on how this adjusts the portfolio. So what in your estimate does this do to, again, that forward-looking optimization, recognizing it's only 5% allocation, so it's relative to the rest of our equity exposure, it's very small, so it's not going to nudge it very much, but it would just be useful to see in terms of expected returns and volatility and correlations and things, just what does the portfolio before and after look like, and which might give some numbers to the assertions. Mr. Diaz.
Thank you. I was just going to ask, given our exposure to Baillie Gifford and the fact that the global index has also become, I guess, more biased towards large cap technology companies, whether there is even a case for increasing a fund like RAFI just for diversification purposes?
Possibly. I suppose there are two different questions on there. The majority of our money is just tracking global equities, which has the happy circumstance of us not attempting to second guess which part of the market is going up or down. We're just exposing to the asset class. We can hear from Baillie Gifford in a minute in terms of why it's our sole remaining active manager, or it's the sole skew away from that asset class return. And I suppose from a committee decision anyway, this RAFI is the third component of our equity strategy, so to some extent is adding that aspect. But I think it's a good point in terms of we can either just default everything back to the passive asset class, or we can skew in a Baillie Gifford direction, a RAFI direction, or any other direction that we choose to go in. Colleagues, any other questions on this? So this was a paper for noting, wasn't it? Or is it for for decision? Hold on, what was it? Oh, it's to retain. So I think it was, yes, it's to retain the allocation. So are you happy with that? I would suggest we are. Yes, so we agree with the recommendation, Mr. Traherne. Thank you. Shall we go on to paper A8, which is about the rebalancing strategy? Are you presenting this one as well, or officers?
Well, I think and I heard the comment earlier from Councillor Bennett. I mean, whether we've misunderstood what was being required of us for the rebalancing policy. My understanding, and I apologise for not having attended the last two committee meetings, is that there has been a lot of discussion on rebalancing, and that what was required was a paper which would provide a draft policy setting out the main principles and explaining how the rebalancing policy would work. But I'm very happy to hear comments. I mean, I guess, to put on the table, my view on rebalancing is it is mostly a means of ensuring that the risk is maintained at the right kind of level across the portfolio as a whole. And that it may be that one can have a rebalancing policy. It may be that rebalancing gives one an additional element of return, but it's more to make sure that if particular asset classes perform extremely well, that one doesn't have a portfolio which is very focused on that particular asset class, and therefore one should kind of bring the risk back to the central positions so that the overall balance is right, and that should be the key behind the policy.
No, I think the principle has been firmly established and is the right thing to do. I think my comments, and I'm interested in Councillor Bennett's to follow up on his earlier question, but my comments are I still think that this is a little bit too vague and indistinct. So just simple things like I just did some maths where I said, well, if Bailey Gifford and Elgin moved by 2.5% each, and then one of the others by 0.5%, that's actually 5.5%. So they would be inside the tolerances for the subsets, but they'd now be outside the tolerance for the total, for example. So the maths didn't seem consistent, and the 5% as a proportion of 70 is a rather different number than 3 of 20, 3 of 45, 1 of 5. Again, that would seem strange because you'd have thought surely there should be consistency, but maybe I'm wrong. And then practical things like we discussed at our last meeting whether we should have a point in the calendar when we just reset the clock and move everything back to wait, or whether we should go with this tolerance band. And actually, I think when we were talking about it, I think actually it's a spectrum between the two. They aren't two different strategies. They actually are one and the same. It's just it's a matter of degrees. But given that we operate on committee cycles, for example, how practically would this operate? I think it was suggesting quarter end dates, but quarter end dates don't align necessarily when we have decision-taking capability. For example, September the 30th would have to wait until this meeting for a decision from us, by which time the numbers would be all different potentially. So there are a whole series of practicalities, I think, that need to be thought through the detail in this. And I would also suggest in this debate, I would imagine in your organisation you've got some very, very smart people who look at statistics and academic papers and can tell us what the first best solution is, and then I think we would follow their lead based on evidence. But until then, I think what we've got now is just a sort of something that any of us could have written is perfectly sensible, but not really getting to this is demonstrably the right way to do it and it's practically going to be implementable. I mean, in another point I just say, I think it says somewhere that it would be used as a guide to aid decision taking, and I'm immediately thinking, hold on, the whole point of this is it's exactly not a guide to aid, it's we must do this, because we all know that the temptation is at the point of rebalancing is not to do it because you think, oh no, but I don't want to sell that, that's doing really, really well, or I don't want to buy that because that's really, really bad. And it's supposed to, I think the rule is sort of half the point, isn't it? So I just think there's quite a lot of detail and crunchiness and rigour that's perhaps still lacking from it.
Yes, though, thank you, Mr. Chairman. The comment around why some of it sounds woolly is that there is always going to be issues going on in the background, which are reasons why one shouldn't be too rigid. And an obvious example is the fact that we don't have a full allocation in property at the moment, and therefore, that there's simply isn't very much that we can do about that, and we should take that into account. It often also happens that there can be kind of cash flows that we're aware of that are going on, or manager changes or whatever, which again should all be kind of put into the mix, which is why this is presented in a way that's not entirely rigid, but there are some very clear numbers, tolerance ranges, both at the top level of equities and property and so on, but also at the manager level, which
with respect,
other things being equal,
we have had this. I mean, this is probably about the third or fourth time in my 7 years that we've done this, and every time we seem to sort of forget we've done it. And I think one of the reasons we forget we've done it is because it's not had sufficient absolute clarity as to what we're going to do. So we say things like, well, we might, we will, potentially. So subject to the rest of the committee's views, I think we need a policy which is quite directive and clear and mechanistic almost. Clearly there's always the opportunity to override it because we can change our own rules, but I think we need to crack this one once and for all, and luckily we've got the time. It's a strategic decision, so there's no sort of time pressure. Let's just get it right, and if we have to reiterate it a few times, I think it's so important. This is probably the single most important thing that that you should do is get your allocations right and then stick to them. So I'd rather that we, if you don't mind, push back a bit and sort of really work on to get it really, really right, and then that our successors have a policy, and they stop with this every 2 years. Let's come up with a policy conversation. Councillor Wilson, you had something to say.
Yes, and forgive me if you covered it in the last meeting, but leveraging on your 7 years of experience, you said we've done this 3 times, we've rebalanced 3 times. Has every single time been taking money away from a performing asset manager, particularly?
I wasn't referring to when we've rebalanced.
Okay.
I hope, sort of, we've done it every year, though I suspect that might not have happened every year. No, I'm more referring to the fact that we've had a policy which we've agreed, but typically it's got lost in minutes or somewhere, as opposed to being a nice standalone document.
Okay, and when we get to the rebalancing conversation, then...
We forget slightly the minute from 18 months previously of what we said we were going to do.
Okay, in my experience, I agree. The only issue about having it hard and fast is, first of all, surely we're not recreating the wheel here. Everybody else must have these sort of policies. Can't we have a look at what sort of best practices on this? And the other thing, as I suppose, is it goes both ways. It's tolerances plus or minus on your report. So, you know, if one of our fund managers halved in value overnight, does that mean we have to put more money into them? I'm not sure we'd do
Yes. Yes, it does.
Yes.
that. Then I'd like some
Other things
flexibility on that
equal.
if it happens in the next 4 months.
Well, it would depend, wouldn't it? I think it would, without putting words into your mouth, if it's been asset class return, so for example, I don't know, equities suddenly got a lot cheaper, that's a rather different matter than the fund managers run off with all the money to Brazil.
Ah, I see, okay.
So if the asset class has got a lot cheaper, the logic is that's making you buy when it's cheaper, which is probably...
But again, that's not explained in the rebalancing policy.
No, to be fair, it's probably implicit, but you're right to
Yeah.
draw it out.
But yes, I mean, as I say, certainly you look at the overall asset class level, and if equities did fall very substantially, one would buy more. One would probably, if a manager underperformed significantly, I mean, it might prompt a review of that manager. But I think, you know, other things being equal, and that's really how this would be phrased, other things equal, one would increase that mandate.
Councillor Bennett, you kick this one off.
Yes. Yeah, so a couple of points. One is and it seems like, you know, I'm a layman in this area, and it seems like it is received wisdom that rebalancing is the best thing to do, but it would still just be interesting to see some modelling. Doesn't have to be our fund, probably better that it's not, some modelling just to show that it is the right thing to do, and also that might suggest at what levels. I'm sure lots of modelling has been done at this. You know, what is it? 3%? Is it 7%? Is it on a calendar basis? Is it when it immediately hits, etc.? So it'd be great to see some modelling around that. The second thing is, and I'm generally a big fan of a simple policy, but I think there are certain complexities around private equity and property. So property, for example, CBRE will say to us, it's not, and as will many property investors, not about the value growth. You go in there expecting a certain return from the rental payments, and then they have to do a revaluation each year, but we might get 1 year where it's revaluated higher than expected, so therefore we have to rebalance, so we have to start selling properties, good properties, that are giving the return that we always expected them to give, and it just seems slightly perverse that we have to start selling properties when we were never in it for the value growth in the first place. I mean, we want them to hold their value, but we weren't in it for the value growth. So property, there's an argument to my mind that that's excluded from the rebalancing, or at least it's on a longer time period. And then likewise in private equity, you know, because they're so illiquid, a lot of these investments, you might get a valuation 1 year, you know, maybe there's a bit of excitement in the market and all these sort of startups or sort of non-liquid companies get valued really highly. Again, that would mean us having to try and sell investments in that to rebalance. So with private equity, I much prefer the strategy, which I think we're sort of adopting at the moment, is that as we see returns, we use that to rebalance, rather than, you know, if we on paper breach a threshold because the valuations of those highly illiquid assets are particularly high or particularly low, we then have to start sort of messing around with the allocations. So, yeah, those are my, I don't know if those are questions or statements, but those are my thoughts.
I do think it's a good point in terms of the refinement for how we'd cope with those illiquid and, in the case of property, lumpy assets. That even with the tolerance bands, you could, as Councillor Bennett points out, you could sort of get into slightly perverse situations where we were forced to do something that was rather, anyway, just because I think this is exactly the sort of thing I think this policy needs to be a little deeper and a little bit more granular and taking into account those sorts of things. Mr. Diaz, sorry, then Mr. Bettle.
And it would be good to understand the practicalities as well, because as you said, if we can only make a decision at a meeting date, then what's the probability that we'll be at the top or at the bottom of a range on a meeting date? Could just mean that rebalancing just doesn't get
So I think governance is an aspect that needs to be in there as far as, you know, so I just think this is great, but we need to go to the next level and think through some of them. We're just almost brainstorming it out here and already coming up with quite a few things, and you probably have people who are expert.
We can spell that out further, and we'll be happy to do that. I mean, in a way, the comments around the illiquids illustrate why one doesn't want to be too rigid about the rebalancing, and that's why there is some slightly loose wording of saying, you know, actually if you're outside, there may be some other factors at play for just, you know, maybe taking a bit of time over the rebalancing. It may be something that will come out of the, that will happen naturally.
Slightly, I mean, so take property. If it's at 24.99 and then goes to 25.01, the logic actually is it then goes from 25.01 back down to 20. So even with a tolerance band, okay, it helps, but it doesn't speak to what happens then. So, you know, a totally arbitrary, tiny change in valuations triggers a sale of a quarter of the portfolio. Or sorry, 20% of the portfolio. Do you see what I mean? If you're at 24.99 and you go to 25.01, the logic is, right, that triggers the rebalancing, and that takes you back down to a neutral weighting at 20. And we'd be telling CBRE we want to sell you 20% of the building. So I think Councillor Bennett's point is a more subtle one, which is to say, even in that situation, what would we actually do? Because I suspect what he's picking up is the reality that we'd probably go, that's a bit silly because it's 25.01 today and it's back down to 24.99 tomorrow. So we'll just override our policy, and that's, I suspect, not a good way to write it if we're going to, in advance, know we're going to sort of ignore it. Is that fair? Please.
I would just highlight from a commercial property view that whilst the market drives value, more critically is the lease terms that are in place. So if there was a rebalancing of an asset which had, let's say, a lease event arising in 2 years' time, it would be a very inappropriate time to consider any transaction on that property until that lease event has actually passed. So I think excluding commercial property from the policy would be a sensible consideration.
Yeah, I'm not sure we can totally exclude it, because I think given that we are in equities and property, basically, if you exclude property, then we've not really got very much to rebalance. But I think that the realities of property investment, and indeed the realities of private equity investment, need to be thought through a little further. I think we've probably given enough of a steer of what we're looking for, so I think it's sort of useful progress, but more work needs to be done would be my summary. Yes?
Okay, we'll take that away.
Thank you.
Thank you.
Okay, can we go on then to the passive equity transition update, which is for information. Mr. Triggs, you can update us.
Thank you, Chair. So the report tabled as item A10 is the implementation of the transition from Algym to BlackRock, which the committee requested at the previous meeting. So where we are with this report was obviously at the time of passing of papers to the committee clerk. We were at a particular position. in terms of the progress made. I've handed out an additional single-side A4 paper of subsequent progress, so I'm happy to defer to my colleague Mr. Hobson to take us through that particular extra bit of progress, Chair.
Yes, I don't want to labour on this too much. Simply, the only thing to note is that's moved on since the previous paper is that it's now got a completion date of tomorrow for this to all be wrapped up. So, in the paper, all of the settlement that had gone from the LGIM portfolio to Northern Trust was in the transition account. It's now moved out of the transition account and has a trade date for the 8th to be all fully settled in the new account with BlackRock. So, happy to take any questions if members have any on it, but it's all on track for where we expect it to be, is essentially where we are.
Good, that's the answer to question 1, so that's good. And the answer to question 2 is, unlike our experience at LGIM, I'm hoping that we've not suddenly found that they've managed to lose a lot of money by being out of the market, or transaction costs that maybe you won't know until you've got the final data, but it'd probably be a good one to send an email around on when we do, just to reassure ourselves that we've executed this transition in line with expectations in terms of cost.
Yes, Chair. As this was mainly an in-specie transfer, there should be very little issues with out the market. So that there are some very small differences between the two indices, but in terms of being out the market, that wouldn't have happened anyway. But there are some cash transfers where there were incompatibilities, but very, very limited. I think it was hundreds of thousands, not millions. So the difference should be very, very small.
Out of $750 million, hopefully those are very small. But when you've got the final data, it would probably just be worth confirming. Colleagues, any other questions on this one? No, well, we hope BlackRock do a good job. Can we then look at paper A10, all the quarterly performance review? There are actually quite a lot of things embedded in here, secretly, or not so secretly, but you might not catch every single one of them. I noted 1 or 2, if I may, and then others I'm sure will want to chip in. Just noting on the asset allocation framework, actually it is interesting that the Adam Street allocation at the moment is 7%, which would sit outside the framework and indeed would beg the question what we could then do about it. And I couldn't remember, but I thought we'd removed the 5% allocation cash, but I may be wrong that we've retained it because it's a legacy of Perford. So I'd just be helpful if someone could double check the minutes as to what we said on that. And on a more substantive matter, we've talked in the past about the risk register, which I see is included in the pack, and I'm very concerned that it's included in this pack because it implies that we're responsible for monitoring it. So now it's in our pack, someone might reasonably say, well, what did you do? Did you look at it? As far as I know, and governance team can tell me, the risk register is not within our set of responsibilities. I believe that's the pension board or the executive who have that responsibility. And whilst it's sort of interesting to see it, if it's not within our responsibility, I actually prefer it's not included, and indeed I suggest we do not talk about it unless I'm told I'm totally wrong, because I think that implies responsibility, and if we're going to do it, then we need to do it really, really well and properly. But if we're not going to do it, then it shouldn't be here implying that we should have been doing it. So it may be a carryover from Westminster, who maybe have a slightly different division of responsibilities. No, we've never done it before, but it has arisen before. I think we've seen it once before. I think it might have slipped into the papers, perhaps on autopilot, but I'm very happy to be corrected if you tell me it actually is within our set of responsibilities, in which case we haven't been doing it, which would be very worrying.
Could we check for the next meeting?
Yes.
Is that okay?
Yeah, as I say, I'm fairly confident that our role, unlike other similar committees on other councils, doesn't, for example, extend into the administration of pensions. It doesn't go into those areas. I think other councils mix those two things up. But I'm just keen, particularly around risk, I mean, this is such an important subject that it's really clear that whoever owns this register knows they own it and takes it very seriously. If it's us, I'm surprised and would be very worried because we haven't been doing it. But if it's not us, then we shouldn't imply that we're looking at it. I think recent experience for several of us on this council are that you have to take these things very, 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 very seriously. So that was one I spotted. And then I'm sure you all looked with great interest at the actuarial report, which is actually incredibly important. And I noted that the discount rate has come down, and it's really a question perhaps for officers to sort of pursue, which is at the moment, although they're coming back down again, but market rates anyway were going up, so swap rates and gilt yields were going up. So I know why sometimes the actuary does this. It's a sort of bit of a safety buffer thing that they build in. But it just sort of surprised me that their discount rate was going down versus up. And it's a little bit up since June, but down considerably since March 2019. Anyway, just to understand the maths would be good. And I noticed in their report the very helpful sensitivity matrix, which I'm sure all of you saw, which rather crude but useful because it shows what happens to our funding position in the event of certain levels of market decline, particularly equity market decline, and also investment returns in terms of, well, if investment returns go down, and you would expect future investment returns to go down as markets rise. Anyway, the point here is that the reason I think that we've taken comfort in the past for a very high equity weighting and indeed therefore a very high risk exposure is because we can, because we have actually now such a sufficient buffer that even in really quite significant market falls, we're still 100% funded. And if our other imperative is to reduce the cost to stakeholders, both employees of the council and indeed taxpayers, what we want to do is hold high expected return assets over the decades to come. Because we have that buffer, we can absorb volatility in a way that perhaps other funds can't do. And I thought that table rather made that point for us in a very useful way. I'm going to stop because those are the ones I immediately spotted. There were probably one or two others, but did other people have things that they'd spotted in this? There's a, this is about an inch of paper here, so.
Mr. Chairman, clearly Adam Street had a very successful quarter, but the Adam Street report is dated June and it doesn't try and explain their performance in any way. So I wondered why their report is not more informative, because it doesn't really list the investments and doesn't try and explain the performance. And clearly something exciting happened in the latest valuation period, but I couldn't find an explanation of that.
How are we dealing with paper A11? Are you speaking to it? There's no one from Adam Street here, is there?
No, Chair. We would share the I would share the responsibility with Mr. Bertlin in terms of the presentation of the paper.
So I think your question is a good one, but probably needs to be transmitted to Adam Street to get an answer, because I don't think officers can necessarily answer that one. Councillor Wason.
Yeah, I picked that up on page 30 out of 50 on the investment risk and then analysis services. On Adam Street, yeah, they had something happened very much in the last year, but actually not in the last 3 months if you look at the table. So it should have been reflected in their report. I didn't really understand that.
I mean,
is that where you got that from, Robert? Yeah.
My guess is because it is illiquid and it'll be some significant holding has been revalued, or there's been a corporate action or something. But I think it's a good point.
Just like to know.
It is a good point. It is a good point. We've talked earlier about CBRE, just in the Northern Trust data. It would be quite useful once we've sort of got some numbers from CBRE that those numbers are somehow fed into our custodian report, because they have a number for our property portfolio of minus 8.45, and I just don't know how that ties into the CBRE numbers, just so that apples and apples. Be a good one to
yes, that
on
would require us, Chair, to make sure Northern Trust have the correct valuation as at a reporting period. We will make sure that happens.
Chairman, just to clarify as well, with CBRE, the account was set up incorrectly by Northern Trust in terms of how they classified it. So they actually classified it as a private equity portfolio, which we know how that had happened, but it means the way that they report is not correctly showing the income and things like that. So we're working with them to resolve it. It's being corrected going forward. We just need to sort out the historical way things have been recorded for the first couple of months.
Okay. No, that's fine. This is all just a learning thing. And in terms of the benchmark, are we going to use the nominal 5% we've always talked about? Because again, I don't know what benchmark they're using. They're using RBKC 16 benchmark, whatever that is. So maybe you can just look at, just making sure that, because this data is really, really important, especially in 5, 10, 20 years' time when we say, well, how did it all work out, that we get the data right and Northern Trust has got the right, as you say, settings and such like. Colleagues, anything else that anyone spotted? I mean, I think we really should note very actively the report from the actuaries, the funding update. This is, again, central to what we do. And we need to be careful about resting on our laurels and being complacent, but a funding level of 133% with actually very conservative assumptions, I think, on the government actuary analysis, which we saw last time or time before, positions is extremely well. And I don't know, again, Mercer, you have more oversight of the marketplace than many, but I would imagine puts us in a pretty good place compared to the street.
Yes, absolutely. I haven't seen the figures recently, but that would be right at the top end.
Yeah. So not complacency, but it does give us that flexibility of action that some others may not have, which we can take advantage of. Colleagues, anything else in this paper, all these papers? No? Good. So now we move on to the private equity allocation, which I presume officers will talk to, paper A11.
Thank you, Chairman. So again, this is arising from the previous investment committee meeting whereby officers and consultant were asked to look at the private equity allocation. Conclusions from the study, and it's supported by an officer paper and Mr. Bertland's paper. But we, as officers, are happy with the 5% strategic allocation. But obviously that's subject to any feedback from members as to whether there is any appetite to increase that. And then in terms of the requirement, in order to maintain that level, it does need a commitment of future monies from 2022 onwards in order that that level of asset allocation is maintained. I'm happy to defer to Mr. Bertland.
I think those are the main points. That private equity does offer a different type of return again, and again we like the idea of diversification, and private equity will have different drivers from investing in standard unquoted equities. This is an asset class which has grown significantly in the last 10 years and has in general performed very well. In thinking about what the allocation should be, it's worth thinking about what the overall level of return that's required from the total asset portfolio. And at the moment, I mean, again, given your very strong funding position, it's not obvious you want from this position to be taking on board more risk. If anything, there are arguments probably for reducing risk. So required return at the total fund level is a consideration, and probably that's just, there's no need to reduce, there's no reason to increase the allocation beyond 5%. Another issue with private equity is around illiquidity, that it is putting money away for a long period of time, quite often for 10 years or more, which shouldn't be very much of a problem given the nature of this particular fund, because it's not very often that you're required to find money at short notice. You can afford to take that long-term risk. But on the other hand, be aware that, of course, you are building up a property allocation, 20% property allocation as well, and the illiquidity from private equity should be considered in that context. And I think one of the other issues around private equity, one should also be aware that it is it's expensive, and that the fees are going to be much higher than you're going to see with any other asset class employed by the fund. So whereas obviously with the BlackRock equities going forwards, we're looking at fees of 1 basis point or less. I mean, very, very small. For private equity, you're talking about figures well in excess of 100 basis points for the total amount of fees involved with this asset class. And that, again, is a reason not to have too much exposure. There's also the consideration of whether Adam Street is the right manager to use if you were to consider increasing exposure. And I would say, and this sounds very similar to comments I've been making earlier, that Adam Street does give very similar exposure in terms of technology, US exposure, so exposure to the dollar, as you're going to find in other areas within the portfolio, whether it's within the core standard BlackRock equity portfolio, or whether it's within Baillie Gifford, which has a particular bias towards technology, particularly kind of new technology, disruptive technology going forwards. That's also very much the same pool that Adam Street will be playing in, and for that reason, I would think that you wouldn't want to be putting more with Adam Street to increase further that type of exposure.
So your recommendation is essentially we commit to levels of investment that maintain our asset allocation. So this is actually steady as she goes. This is a no change recommendation. And I think unless you committee members are either concerned about the allocation, or indeed, as Mr. Burton says, the manager who we're using to access these various funds, or indeed you think we should be increasing the exposure via that route, I suggest it's a fairly uncontroversial decision. But others, what do you all think? Yeah. Okay. Well, I think so. The recommendation is that we maintain our allocation. Actually, just to be absolutely clear, where is the recommendation? Help me, Mr. Triggs. Where's the modelling? So you're actually, so just because this is actually an important one, we're approving a commitment of $30 million from 2022 until when? Because it says subsequent years as required. That's slightly vague. I would suggest no more than 3 would be. I think we
10 million a year for 3 years.
30 for 3 years. So you're asking us to approve $30 million for 2022, 2023, and 2024 calendar years.
And working
Mr. Chairman, with the luxury of being able to review that position.
Yes, of course. I mean, to the extent we haven't, if it's next year and we want to change our minds about 2024, we can. But other than that, you don't need to come back to here. You would have got that approval. I'm really asking what the recommendation is, because I'm not quite sure what you're asking us to do.
$30 million over a total of the 3 years. So 2022 will be 10 million, 2023 will be 10 million, 2024 will be 10 million.
So only a 10 million commitment each year?
Yes, $10 million.
Is that right? That's not what I read in the papers.
No, I think it's if you were to look at the appendix to the paper, you can see that it would take the 30 million.
Hold on.
We did in a sorry, Piers.
Yeah, it says.
I was just going to say, in a previous meeting a couple of years ago, I think, Piers, you gave us a great table which showed how the
I think it's
private equity
appendices.
bath worked in terms of.
If you look at the appendices, I think it's sort of maybe what you're referring to.
Yeah.
Describe.
So there was scenario 1, current subscriptions 210, which sort of goes like that. 2, current subscriptions plus 30 million in 2021. 3, 30 million, 21, 22, 23. 4, I wasn't quite sure what the difference between 3 and 4 was, but yeah. So, Mr. Hobson, I think there says 30 million a year.
That was my complete mistake, Chair.
So again, can I just ask, can you tell us exactly what it is you're recommending us to do, and then we can be absolutely clear what we've decided?
So the recommendation is to subscribe $30 million next year and in the subsequent 2 years, but reviewing that position as it develops.
Of course, but what we're saying is, on your modelling, were we to make that commitment, $30 next year, 23, 24, that will maintain within your assumptions the allocation that is recommended.
Yes, it would be broadly maintain the 5% exposure, indeed.
Within your assumptions.
Within, and it should be said, this scenario planning is provided to us by Adam Street.
Okay.
So
yes, I didn't notice that.
their
Actually,
modelling.
that was a point. I was rather, that feels a little bit like they're marking their own homework. I mean, colleagues, is there any urgency in terms of this? I mean, can we come back to this? If it feels like we're about to spend $90 million without lots and lots of clarity?
My suggestion is that it's been a while perhaps since Adam Street has attended a full investment committee meeting, and perhaps if they were to be invited next time.
That's a different point. I think my point was you were saying that these numbers are their numbers, not your numbers. So I would expect Mercer to check them with your mathematicians rather than rely on Adam Street's mathematicians.
Yes, well, we can agree to we'll review these numbers
okay.
further.
Well then, colleagues, what I suggest is that we defer deciding on this because it feels that, just for diligence, Mercer should sign off the numbers to make sure that you agree with the assumptions and the mathematics, and that you'll then come back to it with a clearer recommendation. I think we'll be very happy to agree it when it comes back, but I just feel it is $90 million is still quite a lot of money, and I think we owe it to ourselves and just to tighten it up a little bit.
Okay.
Yeah?
We will do that.
Okay, thank you. A12 Accounts and Annual Report. Any comments on this from anyone? No? Looking at the chairman of the Audit Committee.
Clearly none from me.
And I noted again the audit findings have come to us, and a bit like the risk register, I'm a bit concerned that they're in the pack here, look. And I would have thought that audit findings should go to the Audit Committee, not to us, because it slightly implies that then we're...
Well, I can assure you they do go to the
I'm
audit.
sure they do, but I'm just saying they should solely go there, because otherwise the implication is that we should be doing
I
something
think it
with
just
this.
comes as one pack.
Maybe. Okay. Well, can we then minute that whilst we've seen these and it's interesting for noting, we are not pursuing the recommendations in the audit because that's not our responsibility. It's the responsibility of the Audit and, is it still Transparency Committee? Yeah, Audit and Transparency Committee, just to be super clear. And I did spot, and I'm afraid I can't find it easily. There is in the annual report there is a one of these ones where the table and the text has been overlaid. So I'll leave that to officers as a Christmas present to find it. But there is one picture which looks a bit silly. Colleagues, anything else from any of you on the accounts or annual report? Are you happy with the bit written at the front? Good. Okay. So that's noted, I think, isn't it? We only had. Do you need us to approve them or to note them?
Committee approving the final product.
Okay. So, colleagues, are we happy to approve them? Yes, we're happy to approve them. Thank you. Good. We'll now turn to our friends from north of the border who've been very patiently waiting, who are going to give us a bit of presentation. They'll give it our only active manager now of any form. So they're very, very rare beast. So we don't have many of these presentations. I was going to suggest, do you want to come up? I don't know if will these three work, these chairs? Yes. So maybe if you sit over there, just so it's easier for everyone else to see you. Really, the floor is yours for as sort of long as you want. But I'd suggest about 20 minutes, otherwise we'll miss dinner.
It's not red. Good evening and very nice to see everyone. I'm Lynn Dewar. I've been working with the Royal Borough for 27 years and I'm joined by my colleagues Helen and Tim. So in terms of the scene setting, basically the investment philosophy over the last 27 years has all been all about long-term investing, and very positive to hear that long-term perspective being echoed in the chamber tonight. What we're going to cover is the portfolio, give you an update in terms of some of the transactions we've been making, and also then just look forward, bringing in some examples of our engagement with companies and just how we're thinking about ensuring the sustainability of the investments we're making on your behalf. If there's anything that's not clear, please do just interrupt and ask. We gave out some packs, so you should hopefully have them in front of you. So on the second page, I've highlighted there the strategy that we've been managing for you. Most recently has been our Global Alpha strategy, very much focusing on long term, and by long term we mean at least the next 5 years plus. And it's very much focused on growing businesses that are going to drive the share price by the profits of the firm. And in terms of the choice of companies, we reduce that down to what we think are about the 100 best companies that we can invest in over that 5 years plus. Now, as the chairman said, we are your remaining active manager. You set us a hurdle to outperform the global index by at least 2% after fees over rolling 5-year periods. And as at the end of September, and very similar as at the moment, the assets are just over 300 million that we're managing. So when we come and talk to you, we give you an update on how the assets have been performing. I put in a range of time periods. In the most recent year, it's been a very strong return, absolutely. But the performance is a little bit behind the overall benchmark. But we are investing for 5 years plus. There will inevitably be periods when the performance is very different to that of the index, because we are only investing in about 100 stocks. The portfolio is significantly different to that of the index. In terms of what's been going well, you've had an investment in Moderna, which, given the focus on vaccinations, has performed well over that 1-year period, and since we bought it for you. But we didn't buy it just because of COVID. We bought it because the technology that they have has the potential to really change how we're treating diseases like autoimmune disease, heart disease, and cancer. So it's really the future is why we're holding Moderna for you. But there's no doubt that share price is going to continue to be quite volatile from here. There's also been other pressures in terms of changes in regulation in China. And that's had a short-term impact on some of the holdings. But in terms of the long term, we don't think that they are actually as significant as the volatility has indicated. So we still think there is significant potential as we look out from here. But when you appointed us to manage money for you 27 years ago, that was very much about adding value over the long term. I've shown the performance since inception. I've shown you the difference there at 2.3% per annum. What that means in monetary terms, though, is significant. You first gave us just over 60 million to manage. Now that has grown, as you saw, it's over 300, but you've actually taken almost 250 million pounds back over that 27 years. So you have been regularly rebalancing from this portfolio, given that very good long-term performance. And that benefit of taking a long-term perspective, of compound returns over the long term, if you had added that, invested that money in the indices that we've been compared against over that period, you would have generated just over 200 million over the initial investment. But the active management has actually generated 481 million. So more than 281 million over and above what the index would have generated you. So appointing an active manager is to significantly add value for the pension fund over the long term. Now, we've done that, but what is important is always looking forward, and that's why the continuity, the stability of the investment philosophy should give you the reassurance that we'll be able to continue to deliver over many years to come. But there will inevitably be individual periods when we're not performing as well as the index. But we hope that because of that long-term nature, you will bear with us, because we will always explain why there are periods when the performance is different. So I'd like to move on to page 4. And this is a very high-level overview of all the holdings we have in the portfolio. So that 100 stocks. When I said at the start we're investing in growing companies, there are many different types of growth. There are growth stalwarts on the left-hand side. There are businesses that have got a really strong franchise. They've got a competitive edge, and they're going to keep generating steady returns over time. And then there are those that are a bit more innovative. And Piers had mentioned technology stocks, so there will be some in here, but this portfolio is not just about technology. And I think this page highlights that very clearly in terms of the breadth of the different investments. So you've got your innovative disruptors under rapid growth, but there's also cyclical growth in terms of different influences in terms of the structural growth over time. And then right at the end, latent growth, where actually there's a catalyst for some significant change that we're expecting in these holdings. But we're constantly making changes on your behalf. So we had a significantly strong period of strong performance, and we were making reductions to those holdings that had performed very well. So in yellow, under the rapid growth, you can see that we'd been making reductions to the likes of Amazon and to the Canadian business Shopify. And Shopify facilitates businesses to move to deliver online. Now, those sorts of businesses had performed very well in the previous 12 months. So we're making those reductions, and that gives the opportunity for us to then invest elsewhere in where we're finding really exciting potential. And Tim's going to highlight some of those examples that are in blue further down that column. Sorry, I think my mic was moving in and out, so I do apologise.
Thank you, Lynn. Good evening, everybody. I'm aware the clock is ticking and we are the road hump between you and your dinner, so I'm going to be quick. But essentially, we've trimmed some of these big technology platforms, which goes to the point that Piers was making earlier on about this emphasis or this focus on technology. that trimming has been a function of two things. First of all, as Lynn said, valuation. These businesses, the Amazons, the Alphabets, the Shopifys, have done very well over the past 18 months as the world has moved online in a hurry. But also, it's the fact that there is a growing regulatory threat to some of these companies, particularly on the focus on the area of data privacy. So a little bit of capital's come out of some of these large technology businesses, mainly US technology businesses. And we've put that capital to play into two separate areas. The first area is what you see at the bottom of the rapid profile, into a couple of companies that actually mix both digital but also physical skill sets. And you may think of Baillie Gifford as an out-and-out technology investor, but we are increasingly aware that companies nowadays do need a physical footprint to succeed. So we bought Peloton for you earlier this year. And this is a really good example of the challenges of behavioral investing, because we've watched Peloton for quite a while. We watched it during the pandemic, and of course the shares went up and up and up. We couldn't go to gyms, so we had to exercise at home, and Peloton growth rates went through the roof. But we bided our time, and we bought in August at $110. Now you may say, why did you buy when the shares were so high? Why did you wait? And the reason is, the great criticism you can level with Peloton is it's an old person's, rich person's plaything. And that's not scalable. And we like to buy businesses that can scale almost infinitely. So we were looking for two things with Peloton before we put your capital to play. And that was age. And what we see now is that actually the fastest growing demographic for Peloton customers are the 25 to 35-year-olds. So that tick in the box, that means it's scalable. Young people like it. But also when you look at aggregate household income, nowadays half of the customer base are in aggregate household incomes of less than $50,000. 5 years ago that was 5%. So again, we were very happy to wait until these markers came through to buy at an optically high level, because what we're seeing is the company setting a base, setting a foundation for many, many years of growth. This is not just a COVID bounce. So that's really the first area, the mixing of digital and physical footprints. The second area is healthcare. We are seeing enormous change on top of huge inertia happening in healthcare. And for a stock picker, there is this deep liquid pool of opportunity opening up in front of us. Now, we live in a world where data is becoming universal, and it's Moore's law that's powered data. It's Moore's law that's powered the returns that we've generated for you. It's Moore's law that's really propelled Amazon, Facebook, Google to use these vast data sets to create a service. Healthcare, for the past 50 years, has been bedeviled by the opposite of Moore's law, and that's Eroom's law. And what that basically states is that actually the cost of developing a drug, of bringing a drug to market, doubles roughly every 9 years. So you spend more and more and get less and less, and that's a really bad deal. But what we're seeing now is that with gene sequencing, you're getting this clash, this collision of big data sets and rapid innovation. And biotechnology companies are really turning healthcare on its head, and that's very, very exciting. So on the left of the page, at the bottom, you'll see a company called Satara. This is a US business. We've just taken a holding for you. It does biosimulation software. So its software models how novel drugs work in your body. It maps drugs across 10 different organs and 25 different population types. And if you think that it maybe takes 5 years to bring a drug to market, well, if you're a business like Satara and you can say to a pharmaceutical firm, we can compress that time and we can compress that cost, then that's a very, very attractive proposition. And again, if you look at America, which is where the company primarily operates, 90% of drugs now coming to market use biosimulation software. So this is a very, very attractive and dynamic growth area for us. Moving on to stewardship, just a few comments, if I may. I think the first thing to say is that stewardship for us, and I hope for you as well, is not a separate, siloed tick box exercise. Stewardship is fundamentally an investment consideration. You can't think about how a company generates long-term profits without thinking about the long-term sustainability of its operations, that they are one and the same. So that's our overarching approach, and it has been for 100 years. But how do we actually apply that to company analysis? Well, we have these 5 principles, which you see on page 5, that we really look at when we're analyzing a company. And in the interest of time, just to highlight a couple, on the left, prioritising long-term value. This is fundamental to how we think about an investment hypothesis. We speak to management, we speak to the boards of companies, and really encourage them to resist the drumbeat of the quarterly earnings cycle. Over the past 40 years, average holding periods on the New York Stock Exchange have gone from about 6 years to less than 12 months. In other words, we've gone from an environment of investment, real investment, to one of speculation. Now, for us, the companies we're buying for you, we want them to flip that logic. And we want actually, the Canadian platform, they take this to the extreme, which we love. They talk about building a company that's going to last for 100 years. And that's exactly what we want to see. Another very important principle, which I'll draw out with a company example, is the fourth, second from the right, fair treatment to stakeholders. We live in a digital world, a world of 24-hour rolling news feeds. Companies do not operate in a bubble. Increasingly, they need societal license to operate. They need to appeal to all their stakeholders. So again, this is something that drives our engagement. It's beyond that Friedman-like mantra of profit, profit, profit. Companies have to look after all stakeholders, from employees to suppliers to shareholders, to drive long-term sustainability, and that's increasingly important. And to give you a real example, when the pandemic struck, we wrote to most of our holdings and said, do the right thing, forgo short-term profitability in this pandemic, look after your staff, look after your people, look after your suppliers. And the responses we had back was really encouraging. Management teams appreciated the fact that we were happy for them to do the right thing. So it's fair treatment to stakeholders. If I can just bring that to life on page 6, this is a very small sample set of some of the engagement we've done for you. I'm going to cover the S and the G of the E, the S and the G. And I'm going to start with an example that's for us is long-standing, but it's also complex and challenging, and that's Amazon. We've held Amazon for you for many years. It's been a tremendously successful investment, but on the governance side, of course, there's give and take. It's 2 steps forward, 1 step back. And the engagement with Amazon over the past year has really focused in 2 main areas. The first has been injury rates in their very big fulfillment centers. Now, Amazon fundamentally is a data business, and yet they don't produce data on injury rates, and that's simply not good enough for a data business. So we've been talking to them, and we've said, in your sustainability reporting going forwards, you have to start producing injury numbers, and they are going to do that. So it's a good example of engagement engendering change. The second example of recent engagement relates to the union vote in their Alabama facility that happened earlier this year. It's the first vote in Amazon's history, and the company did not take a position of neutrality. They advocated for their staff to vote against unionization. Now, we're fine with that. That's absolutely their call. But the manner in which they communicated was out of order. They were communicating with staff 5 times a day in the run-up to the vote. It was overly aggressive and overly fraught. So again, we engaged with the business. We spoke to their head of ESG engagement, Tessie Peshen, and we said, the way you've engaged does not map your charter and values. So in future union votes, please change that policy. So for us, again, it's give and take. Fundamentally, the direction is forward. There is progress being made, but you always have to check and see where more engagement is required. I was very briefly going to touch on the E of the E, the S, and the G with the climate audit, but we are running out of time. Just to say that we did a forensic audit of every single company we hold for you over the summer through a climate lens. And really, it was to understand the granularity beyond a carbon footprint and to find the companies where we need to engage because they're not doing sufficiently well on the climate piece. So that work's in progress, and we've been talking to a range of companies on their carbon duties. As the world transitions towards net zero, this is not about box ticking. This is about fundamentally having a strategy that aligns with the world moving in a certain direction. And if you're not on that path, your customers will start to leave you. This is about returns first and foremost. So I will stop there and hand over to Helen.
Thanks, Tim.
I've just been reminded, sorry, that this room is going to be needed for another committee in about 5 minutes' time. So given that we're all going, we can continue the conversations, of course, over drinks and dinner, but just give you a sort of 5-minute warning.
Absolutely, thank you. I will keep my comments very brief, thank you. Tim shared a couple of opportunities within your listed equity holdings, but I'd like to spend just a couple of moments discussing our private companies investments, turning to page 8, as we think it's a really exciting area of development, and one that's increasingly relevant to our listed equity investing as it helps us to generate and incubate those fantastic growth companies for the future. And it was mentioned earlier in the discussion before our presentation about the growth of the private equity market. So it's worth just setting out the area of the market that we look at. So we focus on late stage private companies and work with them as they move towards IPO. So it's not venture capital, early stage investing where these companies need quite a lot of hand holding. These are already established companies. And what we look for in private companies is really exactly the same as we look for in listed companies. It's transformational growth. But the difference with private companies is that they can choose their investors. What we are increasingly seeing is that we have a reputation as long-term and supportive shareholders, and that these private companies are now coming to us for investment. The more investments that we are making, the more that we are learning from these companies and the more fantastic opportunities that are arising. With our private companies investments, we can also get good insight into the opportunities of the future and also some of the threats. You know, these disruptive companies that are staying private for longer, that could be the new Amazons, the new Alibabas, the new big companies that we've all heard of. So this, we think, makes us better public market investors as well. Increasingly, lots of the companies that we hold privately make their way into your listed portfolio. So within your Global Alpha portfolio today, you have companies such as Spotify, which I don't think needs any introduction, also Peloton that Tim mentioned, we held that privately, as well as companies like Alibaba and also Meituan, the Chinese food delivery company. To put a few numbers around that, at Baillie Gifford we've invested $11 billion over 10 years in private companies. And we're seeing increased client demand for bespoke private portfolios. So today we run 2 dedicated private companies vehicles. One of those remains open to new investors, and I'm sure we'll be very happy to discuss that if there was ever anything of interest. But really, for you today, the key point is that our private company investing is a really fruitful and exciting area of growth, and it does make us better listed market investors. I'm sure we can pick up on any themes that are of interest over dinner. Just to wrap up very quickly on page 9. As Tim said, it's an incredibly broad portfolio, your Global Alpha portfolio, but there are several key areas of enthusiasm. One would be in transformational healthcare. It's said today that we are in the next biological revolution, so lots of ideas from vaccines, as Lynn mentioned, down to apps that can help you track your vital statistics and your health record. And the second would be software. Cloud computing and storage is enabling entrepreneurship and more companies to spend less on capital intensive things and to be able to grow their businesses for the future. So really fantastic opportunities, and we do look forward to the long term and to that long term relationship with you.
Thank you. I'm sure actually there are lots of things we can talk about, but what we'll do, which annoyingly won't be then broadcast, but we can certainly follow up in a minute over drinks and dinner. So thank you very much for that presentation. I would just like to add formally here our thanks to Lynn, and have that minuted, who's been with us on this journey for, as she said, 27 years. And the numbers are fantastic. I might say 1 or 2 more words later, but I thought that should actually be formally minuted, that the committee expresses its thanks to you personally for all you've done. Colleagues, is there any other business anyone wishes to raise? No. All right. I think we'll draw the formal meeting to a conclusion and reconvene in the Mayor's Parlour. Thank you.